This video is about an interesting piece of financial regulation that governs mutual funds in India. If you are an aspiring finance professional, this is a possible topic for you to write an article or a paper about to enrich your CV. Towards the end of the video, I will outline a flow of ideas you could use to write an article. If you, a consultant or a strategy professional, you will benefit from a rather interesting perspective of a financial regulator and their approach to problem solving. Let us define the problem statement first. If you run a mutual fund, there are broadly two areas where things could go wrong. One possibility, of course, is that the investments themselves could lose value. Or you could also have a scenario where a significant number of investors could withdraw their money. When a large number of investors withdraw their money, the fund will need to sell the investments and use the proceeds of the sale to repay its investors. The fund will, however, run into trouble if it is unable to sell enough of the investments. This can happen if the investments are not sufficiently liquid in nature. This brings into focus something we will call the redemption risk, which refers to the possibility of investors withdrawing from the fund. In 2020, 6 funds in India run by Franklin Templeton had to shut down because investors tried to withdraw their money, but the fund could not return the money because they couldn't sell the investments they had made. You will find the link for this in the video description. This brings us to a rather important question. How do you measure this risk? Given a set of investors in a fund, how do you quantify the probability of investors withdrawing their money? If you need to pause the video and think for a few minutes, please do. If you need a bit of help, let us frame the question as follows. There are 2 funds, Fund A and Fund B. They are of the same size and have identical portfolios. Fund A has only 10 really large investors, while Fund B has 10,000 small investors. Which of these 2 funds do you think carries greater redemption risk? Do you get the drift? Large investors tend to be more reactive and more likely to withdraw their money at times of stress, unlike small investors who are unlikely to go through the hassle of withdrawing. SEBI put in place a regulation to address redemption risk in 2021. And it is loosely based on the above idea that it is the size of the investment that dictates the probability of that investor withdrawing. The link to the regulation can also be found in the video description. I refer you to Table 1 of the regulation. Before we close, here is an interesting piece of trivia. Franklin Templeton eventually returned the money from its 6 funds it had shut to its investors. Rather interestingly, Franklin Templeton returned more than what it thought it owed the investors. This is because the final expected payment was based on the valuations in 2020 when the fund shut. Subsequently, the value of the assets rose following the pandemic. It goes on to show that Franklin Templeton did invest in financially sound companies. However, it failed to take into account market liquidity risk, which eventually turned out to be a very costly miss. More formally, it is not sufficient for a fund manager to manage the price risks in the portfolio. They also need to manage market liquidity risk and redemption risk. If you would like to write an article on this topic, here is a suggested flow. You could start by describing the problem of market liquidity and what it means. Note that market liquidity refers to the ease of buying or selling financial assets, such as stocks and bonds. You could then talk about redemption risk that open-ended funds face. You could conclude by summarizing how SEBI's solution is an interesting approach to measuring and provisioning for redemption risk. If you liked this video, please hit the like button and subscribe for more videos.